if we're doing this, this is 15 points wide. And if I look at this and I set up this trade, I'm selling more time premium than I'm buying. This entire trade is done, it's 15 points wide, and it's done for a net debit of $8.75. That means for every 1-by-1 long spread, or another term would be a vertical spread, inside the options play platform, we'd call this a vertical spread. And if you're doing this trade 15 points wide and you're selling more time premium than you're buying, a weird thing happens with your break even. Your break even is actually below where the current marketplace is at. So the max risk is $875 or $875. The break even is this price plus this price. So at expiration, it would be, so in this instance, our break even is the strike price. Of course, I had to pick the wrong strike price there. The strike price minus plus the net debit paid. So we have a lot of leeway in this instance in that we are selling a lot more time premium than we are buying on this trade. And if we do that and we look at this trade, our outlook for the market is that it just needs to stay where it's at, or it can drift higher, and we're still positive on this trade. So some people may say, well, why wouldn't I do the put side of things and actually bring in a credit spread to the trade? And you can start with the short put spread, but I do think it's a lot easier to just understand, and it also helps with the adjustment to start with the long call spread. But the moral to my story here is that if you pay attention to the time premium that you're buying versus the time premium that you're selling, you can pay a net debit for a spread that actually has positive time decay on that trade. So the market's at 58.34. If the market just stays above 58.28.75, if it just stays above that level, we are then profitable on this trade. So we can drift a little bit lower or we can drift a little bit higher. Our maximum risk is 875. If the market goes below 820, that's the maximum that we can lose on the trade. And if I'm looking at this trade, this is the way I like to approach some long call spreads. Now, if we do the trade and it goes up, you're not trying to make all 15 points in this. So I at least got the max profit right here. So the max profit is $6.25. Now, it's not, it's not a 50-50 bet, right? We're not paying $7.50 with the hopes of making $7.50 on the trade. We're paying $8.75 because we got to pay a little bit more because we are actually going deeper in the money and we are profitable if the underlying does not move at all. So we pay a little bit more for that and we give up a little bit of the upside on the trade. So I still don't mind this risk reward, and it has a little bit to do with the higher valuation of the S&P 500 index, a little bit of the volatility skew that happens, but the market is at 58.35. And you have this opportunity to put this trade on, and if the market drifts lower, still be profitable on that trade. I'm going to show you the long call butterfly spread. So if we went in and did this trade and we bought a 15-point wide spread in the SPX, this would be centered around where the stock is at. This is actually from the put butterfly slide, but the stock would be a little bit more closer to where this is at. But the profit and loss graph still makes sense. This is what a butterfly would look like. So if we did the long call spread, now I'm just going to show you the difference in cost with the butterfly. So a butterfly is a long call spread. The 5280 to the 5820 to the 5835 is 15 points wide. You buy one, you sell one, and that's our long call spread. Now you go out and then you go from 58.35 to 58.50. That is a sell of the 58.35 and then a buy of the 58.50, and you end up with a short spread. So what is a butterfly? It is a combination of a long spread and a short spread that has the middle strike the same. So you are selling one of these option contracts right here, You're selling one of those to go along with your long spread, and then you're selling another one to go along with your short spread. So if I'm doing this entire trade, now the credit of the short spread helps pay for my long spread. So $3.40. So where were we at? 875 minus 340 equals $5.35. So that's the total difference between these two trades, right? Now, way different outlook. If I do the long call spread, I have substantial upside potential, right? As the market moves all the way to the upside, I have substantial upside potential. In this, I need the stock to go to 58.35 and just stay right there. And now I got the wings. If it blows it out to the upside or the downside, I'm unprofitable, but I have a lot less risk overall, $3.40. Now, expiration in this trade when we put this away was Friday. So you could say it's 4 or 5 days, depending on if you're going to count the Monday that the trade was on. But that is the length of this trade. And that's also this trade when we put this on too. I want to emphasize that because it's very important, especially in the SPX, that you have 0 DTE options. You can trade. You can go in on Monday and have an option contract and do this butterfly and set it up so that it's done on Thursday, or do the long spread and have it set up so it's done on Wednesday. You have every single day to expiration every single day of the week is going to have an expiration date.